How do Treasury yields work, Mikey? You actually popped this one on me yesterday, and you did it in a nonchalant fashion. I don't think you even maybe knew that this is what our topic was going to be for today, because you were just like, man, why does this 10-year move more than the 2-year and the 30-year? Why do these move so differently? And I was like, all right, well, let's bounce this out and just talk about how yields work, because we have a fantastic suite of yield products from the small exchange, so fantastic that people are trying to copy it, which is a funny thing. And they're also very low cost. They range from $60 in margin to just $300 in margin at the high end there. Small, simple, standard products that trade in yield. Now we want to figure out how they work. What do you think, man?
I think this is a great topic. I haven't even seen the slides today, so I'm super excited to dig into this, mostly because interest rates offer a unique play on the market that is totally unrelated to everything else. I mean, bonds kind of move on their own, especially now we're at such a turning point in interest rates globally, but especially in the US, and we've seen that 10-year yield slide significantly over the last few weeks. So I think this is a great topic for today. I'm excited to dig into it.
Yeah, we got a Fed meeting next week, and we got a lot of interest rates took a huge hit this week. Like this is a very underrated market, what I think is a very cool market that people should dig into. But the problem is that they don't necessarily know how it works when volatility picks up. At its core basis, a Treasury yield, Mikey, is kind of viewed as a benchmark for interest rates across the globe, like in the United States, but also across the globe. And the 10-year is kind of the S&P 500 of interest rate benchmarks. It's where, so many different mortgage lending rates and so many different rates across every walk of life is modeled off of this 10-year yield. And it's as simple as like people tend to think like, oh, well, there's bonds and there's price and there's coupons and there's yields and there's basis points. It's all so complicated. What we do was we took all of that out of the equation and just gave you a straight up yield. Like if yields are moving higher, that means that the cost of lending and all these different things are moving higher as well. It's really that simple. If yields take a hit like they did this week, then that means that the opposite. And you could see interest rates this week went from 1.6% or $16 in the small yield product down to right now sitting around $14 or 14.5, which is 1.4 or 1.45%. It's really that simple. Like, don't add all of these different things into it, like bond prices or looking into municipal debt or corporate debt. Treasury 10-year yield, the most basic benchmark to start out here.
Yeah, absolutely. I mean, you could dig down that rabbit hole if you want. I took a lot of fixed income classes at university. You could talk about interest rate swaps and LIBOR and all these benchmark rates. And there's, muni bonds and corporate bonds, and they all have credit ratings. And now there's ESG bonds, et cetera. But we removed a lot of that complexity with the S10Y product. Now you're just trading the interest rate. I mean, like you said, trillions of dollars in debt and financing is based off this 10-year interest rate. But for us, it's just another product to trade, just another price, feels just like a stock, trades just like an option, really, with the 100-to-1 multiplier. And today it's showing us some unique opportunity with some great liquidity as well.
Yeah, it is kind of similar to, everybody thinks that they understand stocks, and a similar middle ground between stocks and yields is often like US dollars, where people are kind of like, oh, like US dollar, it's such a big idea and big concept. And it's like, once you boil it down to, oh, do you think US dollars are going higher? Then you buy the US dollar future. If you think it's going lower relative to, pounds and Chinese renminbi and Japanese yen and everything else, then you sell the thing. And it's the same here with yields. Like, do you think that interest rates are going back to their normal, 2%, 3%, 4%? Then you buy the thing. Do you think we're going back to zero, potentially negative interest rates? Then you sell it. It's really that simple. But I want to dig a little bit deeper because we have a whole suite of products. S10Y, so named because 10 years of duration, S2Y, 2 years of duration, 30Y, you get the picture, and they move differently. And you look at these Y-axes, Mikey, and you'll see, although it's hard to see maybe, the one in red, S2Y, has moved less than $1 in its futures price, which is less than 10 basis points in yield. What does that mean? Well, we've been stuck between 1% even, 1.0%, and 1 point, where have we been? 7 or 8, 1.8, 7 or $8. Now I'm confusing myself, which is 0.1% and 0.18%. So haven't moved a lot there in the 2-year duration. Now you move that out to 10 and 30 years, we've moved about a full percentage point, which is, so relative to what we were just talking about, 0.1% to 0.2% being the range in 2 years, a full 1% to 2% being the range in the 10-year, in the 30-year, more like 1.5% to 2.5%. They tend to trend together, Mikey, but we see different types of movement. Shorter duration tends to be less volatile. Longer duration, because there is more duration to it, more unknowns, tends to be more volatile, and thus the range is being wider. Does that make sense?
Yeah, I think the way that resonates with me is this time component. So you look at 30-year interest rate, a lot can happen in 30 years. It's that uncertainty that creates more volatility when you compare it to a 2-year interest rate, where a lot of people can forecast and try and project what's going to happen in the next 2 years here. So that cost of money is naturally higher the longer duration you have, and also the volatility tends to be higher. And you see all three of these yields moving pretty closely together. They follow kind of a general trend. But the neat thing about treasuries, especially in the last few years here, is they can also move differently. I mean, there's pairs trading opportunity among these interest rates, 2s versus 10s, 2s versus 30s, 10 versus 30, et cetera, where you're just trading the widening and the divergences between those rates. And that's why the yield curve is so absolutely fascinating to me as a trading vehicle.
No, it is very similar to that stock market. And it's like, okay, if you look at a long-term chart, energy, technology, financial stocks are trending higher or they're trending lower together. But any given day, week, or month, they could be diverging, like we're seeing in energy versus technology. And it's the same story here with 10 years versus 2 years for the last couple of months. We've seen 10-year rates go from 1% all the way up to 1.7%. 2-year rates, like I fumbled through earlier, haven't moved from 0.1% even to 0.2%. So definitely trend together in the long term, but different movement. And let's highlight a little bit of that movement in the 2-year, especially moving into next week's Fed rate decision. Largely expected that the Fed does nothing next week, and thus maybe you won't see a jump in 2-year yields, but you will see some activity coming off of what they plan moving forward. All of that being said, the 2-year is kind of, especially in the last decade, is a binary trade. It's almost like zero or not zero. And right now we're at zero, Mikey, and a lot of people sitting on the long side of that because, as you can see, since 2000 have not gone through zero. Actually, 2-year Treasury yield has never gone negative. A lot of people waiting for that other binary outcome, which is not zero, which has been historically 1%, 2% in the last decade. If you go back to the aughts there, you have 2-year yields in the 3, 4, 5, 6, even 7% handle. But as you can see, the chart lays it out pretty well. It is like we're either at zero and then the Fed is like, oh, we're hiking and we quickly jump up to 1 or 2%. Or we're at 1 or 2% and the Fed says, oh, we're cutting because we have some perceived fear in the market. You can see 08 and 09, the crash was what brought short-term yields down. And then we started to hike a couple of years ago. And then the pandemic brought them down again. Now the game becomes, when are these things going to jump? And thankfully, you can trade it pretty easily with that S2Y product. But does this make sense? A binary trade in 2 years?
Absolutely. And this is such a profound chart to me, is to see a high of 7% in 2-year Treasury yields now sitting at zero. You threw up a chart of the S&P 500 on here. You're going to see it hit kind of that classic double top that followed through, and then S&Ps break up to 4,000. Not really a mean reversion trade here, with Treasuries much clearer that we're at the low end, the lowest we've ever been compared to the average. For me, it's calling for a long position here, but obviously you can express your opinion either way with the S2Y futures.
Absolutely. And so now moving across the curve, the 10-year garners the most interest and most volume, which seems like a weird thing to people. Like people often think like, well, that 2-year, it's what the Fed has the most influence over. And it seems like the most straightforward thing, either zero or not zero. Like, why isn't that the most popular? Well, the 10-year is just, like I say earlier, it's considered that benchmark. Like if something happens from like a Fed chairperson speaks or a non-farm number comes out, the 10-year is most likely going to be the most instant mover and probably the biggest mover. And I bring this up because you brought this up earlier this week. It's gotten to the point where actually the 10-year has greater volatility to it than the 30-year, which is kind of weird. We spoke about earlier, more duration tends to lead to more volatility, but the 10-year has been so interesting to traders, that belly of the curve, that it's actually even more volatile, even though it's 20 years less of duration than that 30-year. It's one of those things, Mikey, that I don't have like a quote or a number to back up, but you just have to trust me that this 10-year is the most interesting piece, and in a volatile interest rate market, it's the piece that people trade most often.
Yeah, it's really interesting to me because I wonder, just trying to think economically, like, is it uncertain expectations about inflation or about growth? Like, why would 30 stay pegged and tens tend to be moving around more? But the neat way, or the neat thing about trading is that you don't have to have a real economic analysis to trade it. But what's so cool is that you can use this 10-year as kind of your anchor leg and then tie on some 30 exposure if you wanted to trade a spread there, or some 2-year exposure if you wanted to trade the spread there. And especially at these levels, I mean, coming off 1.6% in 10-year Treasury yields, like, where do we go from here? Are we going all the way back down to 50 basis points, or are we going to find a middle ground? And you'll see the curve kind of respond to that on both the short end and the long end. So lots to do with 10 years, 2 years, and 30 years.
Yeah, the 10-year and the 30-year definitely seem to be like the more, and it's funny because they're longer term in duration, but for me, they're shorter term in trade strategy because they move more. And you can see it right here highlighted with the fact that S2Y, that futures product, moves less than a dime on its average day, whereas the 10Y and 30Y move 30 to 40 cents. That to me presents a more interesting like day trade or couple of days trade. Like FOMC next week, if they come out and say something that provides upside for yields or downside for yields, I'm looking to day trade that 10Y or that 30Y more than the 2Y, just because there's more price action and there's more people in there buying and selling it, and there will be probably more movement. That being said, the 2-year is a smaller product that maybe it's more comfortable to dip your toe in if you wanted to trade FOMC or you want to just test out yields. It's a product that from the exchange is $61 in margin. There isn't a single futures market out there that has that low of a margin, Mikey, to try out futures. And there's I don't know of any interest rate product that's that small to try out either. So it's a good starting point and a good long-term trade. Like we talked about that binary trade there, but the 10-year and the 30-year are the faster moving, more day trade, shorter term strategy pieces.
Yeah, that's an interesting point. I didn't tend to think about it that way, but maybe use 10s and 30s for the intraday or the swing trade and establish a core position in 2 years if you're bullish on interest rates. And then intraday, I guess you can look to those spreads as well. So many different ways to trade the smalls: speculation, investment, and hedging, even just among this interest rate suite.